What up? Welcome back. It's Trading Unfiltered with my boy Sellers. We're doing something a little different today. We've had, I don't know, I feel like in the last week or two, had quite a few people approach us via Twitter, Facebook, YouTube, even personally, asking us just to kind of break down some basic, terminology, just
Yeah,
basic stuff.
terminology and just little things that me and you say every day, and it just is second nature to us, but to a lot of people it sounds like another language.
Yes. So today we are going to try to break down just we kind of call this stock market 101, a lot of terminology, some basic stuff. This whole video is really just geared towards helping people, I guess for lack of a better word, understand what the hell we're talking about when we do some of our other videos. Because
Yeah.
we just throw out some lingo and some terminology, and people are like, we have no idea what you're talking about. So we're going to try to break some of that down. Um, yeah, man, let's get into it.
Hit it.
All right, all right. So this will be a multi-part series of sorts. We're just going to do some terminology today, some basic stuff. We will kind of continue this through future episodes to try to just lay out some basic understandings. Like I said, a lot of this is terminology for this video here. So without further ado, let's just get right into it.
Yeah.
So again, for people that know anything or basic stuff about stocks, this is going to be boring or very basic, but that's the point of this. The point of this is to break it down for anybody and everybody.
Like our buddies from Twitter or whatever that we trade with, obviously this video is not for you. I mean,
Yes.
It can be, you can watch it, but it's stuff you know.
Right.
But this is for all the people that hit us up, that we talk to, friends of ours, whatever. We'll be trying to explain what we do, and it's a lot easier just to show it like this.
That's exactly right. So we're just going to kind of get into this, just jump right into it. But the first thing we get asked about, probably more than anything, is so me and you we're primarily short sellers, right?
Right.
And people get confused on that. They think that short selling is we're in and out quickly. We're buying and selling very quickly. We're in it for a short period of time.
But people on Twitter, they think that my name is, they say my name's Sellers. I had a guy message me and he was like, he was mad about short selling, and he was like, you advertise that you're a short seller, it's in your name. I was like, man, no, that is my name. Like, literally.
That's my literal legal name, sir.
Legal name. Yes. I promise.
That's funny. People get mad at short sellers, but so we just wanted to break it down a little bit. So again, basic stuff for a lot of people, but so buying, right? Buying and selling. That's what everybody knows. When you buy something, that is the act of trading your money to buy stock. And then when you sell it, you're taking those shares that you have bought and you're literally selling them for whatever the listed monetary value is. So you buy it at 5, you sell it at 10, you've made $5 a share. You buy 1,000 shares of that stock, you've made $5,000. 100 shares, $500. That is what everybody knows. Everybody knows the old buy low, sell high. And sometimes we participate in that. You more than me. You participate in that more than me. Yeah. Like, you're much better at going long, as we say, and we'll dive into that too. But what we mainly do is this other part down here where we are literally where it says short sell. That's what we are doing. So when we talk about we're shorting a stock, right? We are literally borrowing shares from our broker that we use. We're borrowing those shares from our broker. Let's say at $10 a share, in the hopes that that price will go down. So when we say we're short selling, we're literally trying to make money on that stock going down. Literally the complete opposite.
And I think that this is probably the hardest thing I've tried to explain just to people that don't know anything about trading, or or just know the basics. This is one of the this is the number one question I get asked by people getting into it that hit me up or whatever. It's so hard to explain. I'll tell people, I'm like, yeah, man, I'm mostly a short seller, and they're like, oh yeah, I do short ones too. I'm only in for a little while, and I'm like, no, I'm talking about I don't buy stock typically until I'm covering, but that just
yeah. It is confusing, but we are literally profiting from the stock going down. So when we say we are short selling, without going into it piece by piece, detail by detail, we're literally borrowing shares from our broker to short the stock and profit on it when it goes down. But that's a whole separate process that your broker can help you with on making money when it goes down. So you're actually shorting the stock. You're short selling, borrowing shares from your broker in hopes that the price goes down. And then you're actually buying that stock back. Because when you borrow the shares from your broker, you're not paying your broker for those shares right then and there. You might pay a borrow fee, which is, a transactional fee that you're paying your broker, but you're not paying him for those shares at that price right then and there. But when you buy to cover, you are then buying back those borrowed shares from your broker at whatever the indicated price is from the market. And you're hoping to keep the difference as a profit instead of paying back the broker. So I guess an example is we said, you go long from, you buy it at 5, you sell it at 10. You've made $5 a share. The inverse of that is we short the stock. We short sell the stock at 10 and we hope it goes down to 5. And we've still made $5 a share. We've just done it the other way.
It's literally just what you know about, but in reverse.
Exactly. And it's as far as borrowing shares from your broker, you're basically borrowing them up front. We're borrowing those shares from our broker at, it's worth $10 a share. That's the price that we're borrowing from. When we buy to cover, we're buying those shares back from our broker at $5, even though we acquired them at 10, and then we're selling them back to the broker, or buying them back from the broker, at $5 a share, and we're keeping that difference from 10 to 5. Adversely, if we borrow those shares at 10 and it goes up to 15, well, then we got to pay the broker back that $5 a share where the stock has went up. Same as if you're buying low and selling high. If you buy at 5 and it goes down to 2 or 1 or even 0, you've lost money. So, yeah, like you said, literally the same concept: buy low, sell high, that everybody knows, and we're flipping that on its head. We are literally doing the exact opposite, but you can profit in both directions. And go ahead. I was just going to say, I don't think most people know that, but you can profit on a stock when it goes down.
Yeah, exactly. And don't believe the stuff that you hear from all the YouTube guru people that act like short sellers are bad. Like we're not making the price of this stock go down. The company is terrible. That's the company that we're trading, that we're shorting. They are the reason that we're shorting them is because they deserve to be shorted.
Yeah, they're a terrible company pumping up their stock to levels that they have no reason to be at, and we're literally just shorting that ridiculous move.
And all they're trying to do is profit off of retail investors or traders or whatever, anybody who, somebody with their whatever Robinhood account, I'm going to invest in this company, and they buy it and it goes up, and they buy it while it's going up, and then the company starts liquidating on them. That's what we're doing. We're finding stocks like that, and you can short stocks like big stocks like Tesla or whatever. And
yeah, Apple, Amazon, you can short or long any stock. Look, pretty much any stock out there. So that's what this next part is. Like going long, going short. Going long is, it even says when you go long, you're purchasing stock, hoping to profit from an increase in the stock price. That's what going long is.
And I want to stress on, just because I answer this question to so many people, and not that I mind, it's hard. It's so hard for me to explain it, or for me to explain it in a way that people understand. I'll be telling people, yeah, I longed it here, blah, 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 whatever. When I say long, they think that I'm assuming that people think I'm saying that means that I'm buying it and I'm going to hold it for a while.
Right.
But that's not what it means at all.
Yeah, and that's the reason I put these terms like this, going long, going short, because when you and I are chatting back and forth, we say going long, going short, and that's what we're talking about.
I just want people to understand that the term long literally just means to buy.
Yeah, when we're longing a stock, when we go long, that's in the case we're trying to buy low, sell high. When we're going short or shorting a stock, that's literally complete opposite. We're literally doing it in complete opposite order. We're selling high, buying low, and profiting on that drop.
Literally, if we're shorting something, we could just be saying that we're selling it here, but we don't own it yet, but we're selling it here. You could just replace those words with buy and sell. They mean the same thing.
Right. And the reason I put day trade underneath going long, going short, because when we say short sell, a lot of people think we are in and out same day very quickly.
But they think we're talking about buying.
Right. And that's not what we mean. So when we say going short, it's not we're in and out quickly same day. That's a day trade. That's what this next definition is. Entering and exiting a position within the same day of the market being open, including pre-market and after hours, which we'll get into the pre-market and after hours piece further down. The next definition, swing trade. So swing trade is just not a day trade. You're entering a position and exiting that position on different days. You're buying it on Monday, you're selling it on Tuesday, or you could buy it on Monday in January and sell it on a Tuesday in March, whatever. Swing trades can be long-term, they can be short-term. The main difference is one's a day trade, one is not. But we'll get more into that piece further down.
I just want to stress this whole first part of the video so much because
stress it again because I'm about to switch pages.
I don't mean it in like a rude way at all, because I'm I'm happy to explain anything to anybody, anytime, friends, whatever, people learning. It doesn't matter. I want people to understand that, like, when I say short, I'm not talking about the amount of time I'm going to be in the trade. I'm talking about the stance of my position on that trade. I guess if that makes sense. I'm not saying I'm shorting this. I don't mean I'm going to buy it and sell it 5 minutes from now. I'm saying I don't own this, but I'm going to borrow these shares and sell it before I buy it. Just literally what you already know how to do, but in reverse.
Right.
And if you're using we're going to get into this later, but if you're using Robinhood or any of these other like low quality brokers, you're not shorting anything. So just know you cannot short on those.
Yeah, and we'll get more into that further down. So this page here, the first three just breaks down the time pieces of the market, because sometimes in our videos we do say the terms intraday or pre-market or after hours, and that can be confusing too. But the gist of it is, and this is all in Eastern time zone because the market runs on Eastern time zone. Wall
Right.
Street, Eastern time zone. But intraday, aka regular market hours, 9:30 to 4. You and I are in Central, so for us it's 8:30 to 3. But either way, the regular market hours, that's what that is. Some brokers only allow you to participate regular market hours. They don't allow you to trade pre-market. They don't allow you to trade after hours. Some brokers only allowed you to trade regular market hours. The main thing with regular market hours is, and we'll dive into this a little bit more further in, but most of the trading volume, most of the trades that are executed on a stock happen in the regular market hours. Beyond that, you have pre-market and you have after hours. Pre-market listed 4 a.m. to 9:30 a.m. For us, it's 3 a.m. to 8:30. And then after hours, 4 to 8 Eastern. For us, 3 to 7 Central. So that is the entirety of a stock market day. So really, and most people don't know this, they think of the market opening at 9:30, closing at 4. Well, technically, pre-market starts at 4 a.m. and technically the market stays open till 8 p.m. But again, the majority of the trading is done regular market hours. Pre-market and after hours is there. So when we say in a lot of our videos, we've said this multiple times. I know I've said it. I don't trade pre-market. I never trade after hours. Usually come, for us, 3 o'clock, like I'm getting kids off the bus. I'm doing other stuff. I'm not fooling with after hours trading. I don't trade pre-market kind of for the same reasons, because I'm getting kids ready for school. That's the bulk of my reasoning. Lower liquidity, and we'll get into that too further down. But
you can get absolutely destroyed in pre-market and after hours trading.
Yes.
And I will say, I've gotten destroyed the hardest I've ever gotten destroyed in regular market hours. But I've had some wild things happen in pre-market and after hours. And like you said, we'll get into a lot more
Liquidity things, yeah.
and just details of it to explain what we really mean. And if you're on a low quality broker like Robinhood, you don't have to worry about it anyway, because you can't trade pre-market or after hours. But it's better to just steer clear. Well, unless that's part of your strategy, but
yeah,
stop losses don't work.
Yeah.
Stop losses don't work in pre-market or after hours. You can't do market orders. You can only do limit orders. If you're shorts, I mean, things can skip up on thin air if you're shorting. You can
we'll get into a little bit more of that too. But that's because I'm trying to include definitions that we talk about on this podcast quite frequently.
I know, and I start getting into it, man. I'll start talking about it.
Yeah, and we could go. This could be a 2-hour long thing if we wanted it to. We're trying to keep it simple, and that's why I'm putting these definitions on the screen. So by all means, screenshot them, whatever. Don't care. But this next part, you want to do this part?
Yeah. Okay. So the bid definition: when a trader in the market makes an offer to buy shares. Hang on, I'm sorry. Because it was in between my two monitors. I'm moving it around. Anyway, so the bid. This part,
I think of it like an auction.
Okay, yeah, that's a good way to put it. I mean, I'm always looking at it on level 2, and I know we're going to get into that in just a minute. But yeah, an auction, that's a good way to put it. This is the availability of what people are willing to pay for said stock, whatever, XYZ, Apple, Google, whatever it is. This is what people are willing to pay for it. Say it's $100 and that's what's on the bid. Um, that's just
That's it. That's a bid.
The ask is just the exact opposite. It's people that already own it, whatever, institutions, blah, blah, blah.
Could be us.
Yeah, it could be us, it could be you, whatever. This is what people want for the stock. This is the price that they're willing to sell it for. And it's there can in level 2 it could be stacked. There's you can set limit orders, whatever. It
We'll
goes
show.
up.
I got a sample level 2 screen that we'll be able to kind of break down some bid ask type of stuff. But this just get your feet wet a little bit.
But the bid ask spread, the difference between the highest price at which someone is willing to buy shares and the lowest price someone is willing to sell shares, that one right there is big on what we do. It's not
Yeah,
going to
and
matter.
we say that a lot. Like on our episodes, I watched back a couple. We say the word spread a lot. Like spread can be nasty or the spread was high or whatever. But go ahead.
Just for example, since we were talking about the after hours and pre-market trading, something with low liquidity, not a lot of shares being traded, whatever. Let's just say, since most people are buying stock, let's say you bought some company, whatever. It was some IPO. I know that's another term. It's a new company. It just came out today. They just got listed on whatever exchange, and they ran up from $3 to $14, and now it's after hours. And you say, I think this is going to go up, whatever. You buy it at $14 and it immediately starts dropping and you want to sell it. There might not be a bid. Like the closest bid's at $9 and you want out of it right then. You're losing a ton of money. You have to hit that bid, or you have to sell it at that bid. And that is what the spread is. When we say a nasty spread, or is that a pretty good definition? Would you say?
Yeah, because sometimes we'll get into a stock. I think RSLS is a ticker that comes to mind, and the ticker is irrelevant. But basically, like sometimes the bid could be $3, right? People are willing to pay $3. The ask could be $4. We've seen dollar spreads before. It's not totally uncommon in small caps. Sometimes that spread can be very far apart. So if you're trying to buy it or sell it or whatever you're trying to do, the difference between the bid and the ask can make it difficult to get executed. Or sometimes you're having to try to, if the bid is $1, the ask is $2. Sometimes you're trying to buy it at $1.50, but you don't get executed. So you up it to $1.70 or $1.80. When stocks have thick spreads, it just creates a major problem of getting executed, for one. And two, if you do get executed, which the definition literally right under this is execution is the fulfillment of a stock order. But if you get executed on a thick spread stock, let's say it's $1 bid, a $2 ask, you do get executed at $1.50. But then literally 2 seconds later, the bid is 50 cents and the ask is $1.25. For you to get out of that, 2 seconds later, you're already underwater because that spread is so thick. So the general rule with stock,
thick or thin.
I guess thick in the sense of like, I shouldn't say thick or thin. When the spread is far apart, if the spread is far apart,
you don't want that, is what we're saying.
Yeah.
That's not a good thing. And I didn't give the greatest definition either, but it all kind of goes back to the after hours thing, or
regular market hours. You just don't want that spread to be far apart.
Yeah, something thinly traded. The issues of liquidity with that are really going to screw you. I mean, you're talking about, let's just say, for example, you shorted something at $2, or better yet, you longed something at $2. You bought it, and you think it's going to go to $3, and you're willing to risk it going to $1.75. but it's very thinly traded, low liquidity. Next thing you know, this thing slams to you have your stop loss set at $1.75 market stop. So you're thinking, oh, I'll get out at $1.75. I'm risking 25 cents, whatever. Well, this thing slams to $1.19. I mean, we've seen stuff like that happen.
Oh yeah, absolutely.
You just lost way more than you were planning on. Got filled all the way at the bottom of that, and then it pops back up to $1.75. Whatever. That's what we're saying. Something like that with the spread. And we're just kind of giving horror stories, but
Yeah, well, I mean, really, for any new traders, the idea is you don't want to trade. I wouldn't recommend anybody trade stocks where that bid ask spread is pretty far apart. I don't even now. I don't like to trade stocks where the spread is bigger than ideally 2 or 3 cents. I just don't like it. It can be tough to get executed. You can get into an order and already be underwater because your execution was poor versus the spread. And we have a sample level 2 screen where we can explain more about the spread on that screen.
And the more you get into this, and the more size that you start using in your trading, the more shares that you have involvement with, how much capital you're putting in, this just becomes more and more of an issue.
Yep.
If you're trading 10 shares, it doesn't matter. I mean, I say it doesn't matter, but
it's easier to get executed.
Yeah, if you're trading 10,000 shares of a $2 stock that's thinly traded, well, you're going to have some issues. Am I doing okay with that? Is that making sense?
Yeah, because you think about it from an auction standpoint, you can have a hard time finding a buyer willing to pay X amount for 10,000 shares of a stock. That's a lot. But when you talk about 10 shares or 100 shares, you're easily going to find a buyer for that. But it's a lot different with a bigger, it's harder to find a buyer for a Ferrari than it is a Acura.
Exactly. And I mean, me and you, we're not like huge traders, pushing millions of dollars worth of size, but there's plenty of times where we might take a $10,000-$20,000 position, and I've had market stops, and it'll stop me out in 3 different places on a short, and I lose a good bit more than I was planning on. Just the other day, about 2 weeks ago, it happened to me.
Yeah. We'll get more into that too, but anyway, execution, like I said, that's just you're literally getting executed. Your order is getting executed. Limit order down there kind of gets cut off a little bit, but basically, this is a specific type of order where you're providing instruction to the broker to only execute you at a certain price, and it is their responsibility to execute you at that certain price. So if a stock is trading for roughly $1 a share and you want to buy it, but you want to buy it at 99 cents, and you put an order in to only purchase it at 99 cents, it is your broker's responsibility to get you executed at that price or as close to that price as possible. We mainly use limit orders because it does protect you at getting you executed at a certain price. Yeah. But there is another type that I am going to pull up here next.
And I man, I start talking about what you've got in the next slides beforehand, just because
we get to rolling.
I get worked up. I get worked up easy with this stuff. I'm sorry.
That's good. But the top part of this screen is continued on limit order. For example, a trader could place a limit order to buy a purchase 100 shares of a stock at $10.20. The broker will attempt to buy those 100 shares at a price of $10.20 or less. And that is the broker's responsibility to get you executed at that price. Pros and cons with limit orders. Pro is it gets you executed at the price you specify or as close to that price as possible. The con is if that price doesn't get hit or that price gets skipped over, you won't get executed. So pros and cons. With a market order. Yep, go ahead.
Before you say that, I just thought of this. One more thing. Because I was actually talking to somebody a day or two ago, and I was trying to explain to them how me and you, I said, me and my buddy Craig, we're partnered up with Cobra. That's our broker of choice. We really like them. blah blah blah. And I asked, "Who do you use?" And they said, "Oh, I do my own. I don't have a broker." And I was like, "Well, no, this is just something for newer people when I'm explaining the terminology. When we say our broker, what I was trying to explain was Cobra is our broker. They're like the middleman for what we're doing, but they don't control any of the money in our account. It doesn't. What am I trying to say here? When I say broker that we use, like if you trade on E-Trade or you trade on Robinhood or you trade on Webull or whatever, that's your broker. That's the broker you use. I understand you control the capital in your account, but does that sound pretty
No,
good?
yeah. It's basically like a bank account. This bank account just allows you to buy and sell stock freely.
It's exactly what it is. And by the way, brokerage accounts, they're all FDIC insured up to $250,000.
And broker matters, but we will get into that a little bit later as well. Broker matters. If somebody tells you the broker doesn't matter, they are lying to you.
The broker is one of the. I mean, there's and we need to talk about edge in our next video, but there is a huge edge in just having the correct broker.
Yeah, it matters. And yeah, we'll definitely get into that more too, because that, to get into it, small size. I don't want to get ahead. We'll talk about that.
I'm getting too far ahead, man.
No, it's fine. It's fine. So market order, limit order, you specify the price. Market order, you're literally telling your broker, you're providing them instruction. It's just and it says buy or sell as quickly as possible at whatever price is currently available.
Yep.
In the next line, it says market orders can be expensive if there's not enough volume. We'll dive into that a little bit further down. The reason I put if you're going to trade penny stocks, never use market orders, because sometimes with penny stocks, you can have big spreads and orders can skip around very rapidly. So using limit orders kind of keeps you safe because you're specifying the price that you want to buy or sell or whatever. Market orders, you're literally telling your broker to just get me in where you can get me in or get me out where you can get me out. Again, there's pros and cons to this. Like I said, with limits, pro, you specify the order. Cons, you might not get executed. With market orders, it's the exact opposite. With market orders, you're not specifying the price, but you will get in or out pretty damn quick. Unless you have some crazy, huge, massive position, which most people, 99% of people, don't have to worry about that. So there's been times you or I are in a position, it's going against us. We try to use limit orders and we can't get out because it's moving too fast. So we, on our hotkeys or on our setups, I have what's called a GTFO button. Get the F out. Get me out of that position. Whether I'm long or short, it gets me out of my position 100% at the market price. I don't care what the price is. Just get me out of that order. That is just a fail-safe type of order. So limit orders, market orders, they have their place. Both are good for certain situations. And to be honest with you, sometimes on stocks that we're shorting, if we get shorted a very good, nice, high level and that thing just fades all day long, and it's just, at the end of the day, it's not really moving much, I'll just mark it out because it doesn't matter. The spread is tight, right? There's only a 1 or 2 cent spread there. The price isn't very volatile. It's faded all day. I'll just use a market order because it doesn't matter. But on volatile stocks that are moving very quickly, in my opinion, that's where you use limit orders. But I think both have their place at certain times. So that's where I stand with those type of orders. Would you agree, or what do you think with that?
I agree, and I hate to get into a story, but I'll just tell something real quick. I used to trade it. I used to let stuff go really far against me, and one time I had a position. I'm not going to say how much, but it had gone against me all day. Very, very extreme. And by the end of the day, it had come all the way back down to my original entry price. I was safe, whatever. I was like, all right, it's the end of the day. It was like here, it was like 245. I was like, I'm just gonna mark it out. I'll mark it out, and the liquidity was low at this point. It executes me, and I lose like almost $2,000.
Yeah.
So I was like, oh my god, I almost, which I was thankful I didn't lose as much as I was down at the height of it. But
Right.
anyway, that's a time when you don't want to use a market order. But at the same time, I shouldn't have been in that situation anyway. Don't let trades go that far against you. I don't anymore, but I used to.
Yep. So go ahead. I
was just gonna say that's one time you might want to consider if you've got a bunch of size or something like that, or you're trying to get out of something and you have a price in mind. But like you said, if something's faded all day and you're up huge.
Yeah, and I'm glad you mentioned liquidity, because that's where we're going. So volatility is the next one. Super simple. It's a measure of how fast or how much the stock can move up and down. For example, things like Apple, pretty, slow, even moving stock. It might move a little bit here and there. Not a lot of volatility, so to speak. But some of the stocks that we trade are very volatile. But that's what we're looking for. Our style of trading, we're hunting for that volatility. We're hunting for these big, crazy moves, and that's what we're playing. That's all that is. So when we say stocks are volatile or volatility, that's what we're talking about. Super simple with that. And as it says, they can provide great profit opportunities, but also come with greater risks. So that's why we preach risk management all the time. And hand in hand with that, and we've mentioned this numerous times throughout this video already and on our other videos, liquidity. Liquidity, it's just a measure of how easy it is to buy, sell a stock, basically get in or out of it. That's what that's a measure of. So the second line, if a lot of buyers and sellers are actively trading a stock, you'll generally find it easier to enter or exit a position. The stock is more liquid. So think about it from an auction standpoint, right? If you're auctioning off a signed pair of Michael Jordan game worn sneakers, how many people you think are going to be bidding on that thing?
Do you want to be in a room with 3 people or 150 people?
Right. If you have a pair of Michael Jordan signed game worn sneakers with a room full of sport fanatic fans, 100,000 people in that room, all love Michael Jordan, and you put up a pair of those sneakers, everybody in that room is going to be bidding on that pair of sneakers. You would have no problem selling that stock to that room of people. But let's say that same room of people, you're trying to sell I'm looking around here, a Barbie doll, right?
Yeah.
100,000 people, huge sports fans, love Michael Jordan, and you put up for auction a Barbie doll. How many people you think are going to be willing to buy that? So when you're trying to sell it, you're not going to have a lot of buyers, hence makes it difficult to get executed, to sell that stock or to have a buyer for that stock. So when we talk about liquidity or how liquid something is, that's what that is. It's just a measure of how easy it is to buy and sell that stock. That's what it is. And the next thing literally goes hand in hand with it. Trading volume.
And this is your favorite.
I'm a volume dude. That's all I care about. Volume.
And I mean, it's a big one for me too.
Yeah, that's my baby. Every indicator I use, everything I'm looking at, all revolve around volume, but it is the number of shares being traded at any time. So you can look at volume from a minute standpoint, from a 5-minute, 15-minute, day, whatever. It's just the amount of shares of that stock that are being traded. More trading volume means more liquidity, more traders that can easily enter and exit positions. If you don't have a lot of volume, that means it's low liquidity. You might have a hard time getting executed. But those go hand in hand. If you have a ton of volume, you can easily get executed. If you don't, it can be a problem. So let's say you own 100,000 shares of a stock. You only have 10,000 buyers over the course of an hour. You're going to have a really, really hard time getting rid of that stock. But if you have 100,000 shares of a stock and millions upon millions of volume of that stock per minute, you will have no problem getting rid of it. So trading volume, liquidity go hand in hand. And yes, volume is it's my baby.
King.
Oh, you miss King. Oh, you know what? There may have been more on that screen. Let me go back. I could be wrong about that.
I think there was market cap.
There was. Went too fast. All right. So market cap, total value of all the company shares. Real simple, dumb definition. If a stock trades at $1 a share and the company has, I don't know, 1,000 shares worth of that stock available, trades at $1 a share, $1 a share times 1,000, that equals that company's market cap. That's it. And the reason I put that on here is we do talk about market cap sometimes in our videos. So market cap is just it's just the value of the company based on the price of the stock times how many shares they have. They have 100,000 shares of the stock, trades at $5 a share. Their company's worth 5 times 100,000. Their company's worth $500,000. And most of the stocks that we're trading, at least for me and you two, they're all under like $1 billion. It's very rare that I'm ever trading a stock that has a market cap bigger than $1 billion. Most of the stocks that we're trading have small market caps. That's why we call them small caps. When we say small caps, we're literally talking about companies where the market cap is relatively low, especially compared to things like Apple, Tesla, Google, Amazon, whatever. So when we say small cap, we're literally referring to companies where they're just cheaper companies. If we say large cap, we're referring to the Apples of the world, the Teslas, the Amazons, etc. So
We trade them because they're terrible.
Exactly. Like if we're going to, I'm not real keen on shorting companies like Apple. One, because there's not a lot of range and volatility. And two, because they're a good company. Really don't get real excited about shorting Apple. And the first line on this page just breaks down market cap. For example, if a company has 1 million shares of the stock available, the stock price is $10 per share, the market cap is 10 million, as I kind of broke down. Float. You and I talk about float a lot on our show. I notice we say low float quite often.
Yeah, this is a big one for us.
Break it down, brother. Break it down.
So I think this is something that a lot of new people might not take into account how serious this is, and it goes along with everything, the liquidity, all of that. Public float, free float. Yeah, I mean, just float that's the amount of shares available for you or I or whoever to trade.
Yep, the public.
Like you said, if there's 10 million shares, or a million shares, whatever, a low float to us is going to be something under.
Yeah, so this is where it gets a little tricky because you could look up, low floats or micro float from 4 or 5 different sources, and everyone will tell you something a little bit different. But for me, I consider low float for me, I consider 10 million or less. Anything under 10 million, I consider a low float. Now, when I'm talking about micro float,
that's under 1 to me.
Yeah, in my mind, I'm thinking 1 to 3. And the reason we say those terms is because typically the lower the float, especially 1, 2, 3 million, really anything under 10 million. The reason we say that on our show a lot is because if something has a low float, that thing can move crazy. Yes. Low float stocks can be very, very volatile versus a float that is much higher. If a float of 100 million or 50 million, you don't see these big, huge spikes in price on a very short time period. And again, go ahead.
No. I'm just, I'm just wanting to reiterate the fact that something with a low float, whether you're long or short, you can make or lose a ton of money really, really fast. And
Yep.
it's a lot easier to lose a ton of money really, really fast. So proceed with caution when the float is small.
I'm not even I used to never trade stocks that had a float lower than 2 million. I used to just filter them out, didn't even look at them. I'm still not keen on it. Sometimes I'll look at them, maybe the setup's there, but again, for new people, in my opinion, sub 3 million, you shouldn't even put it on your screen. You can get into a lot of trouble, long or short. There's just inherent risk either way, long or short. Doesn't matter.
I've gotten destroyed on both sides.
Yeah, so
I
low
made a lot of
float.
money on both sides with them too. But
Yeah, and there's yeah, like you said it. High risk, high reward with low floats. Basically, that's what it is.
yeah,
But you just again think about it from an auction standpoint. Low float, right? If there's only
I think of this as being more like the less people in the room type thing.
yeah, less
I
of the item.
less of the item. That would be it. There's
Yeah.
less of the item.
No, you're right. Less of the item because let's say again we go to the sports analogy. 100,000 people in the room, only 5 pair of game worn Jordans come through the room. That auction house is going to be going nuts, and the price is going to be fluctuating like crazy because there's only 5 pairs, and that
Right.
price is going to go absolutely bananas. But if you bring into that same room of 100,000 people a Golden State jersey that you have 80,000 of,
Yeah.
the people aren't going to be bidding like crazy because you have so many. It's going to be so easy for them to acquire that. So the smaller the float, basically, the crazier the price can get. If you see a sub 10 million float, it can get real tricky real fast. And as far as
definition, I like
yeah,
that.
and as far as finding the float, that's just basic fundamental information. You can find it online, Yahoo Finance, Finviz. There's a bunch of different sites to find what the float is. But the general rule is 10 million or less, you're getting into low float territory, and it can move very quickly, very fast. And without going into too much detail around strategies or whatever, high risk, high reward for low floats. The higher the float, typically the less volatile moves you'll have.
But it just in general, when you're short selling small caps, just we talk about it a lot. Float is it's a huge fundamental factor that you need to take into place. Like it's not something to take lightly. You need to know it.
Yeah, at some point we'll do a video, maybe deep diving into more on creating watch lists and prep because we do look at fundamentals every morning, float, market caps, financials, etc. But float is one we look at every single time.
I'm not taking a trade until I know the float. I have to know the float.
Yes.
That completely the float and the market cap to me completely determine my game plan on how I trade a stock or if I trade a stock.
Yeah, because like I said, it's sometimes for me if it's under 3 mil and the setup is just not perfect, I'm not going to touch it. Sometimes if it's sub 2 mil, I'll just take it off my screen altogether. I don't even want to fool with it. But that's what a float is. I left broker on for last, and we kind of touched on it. But it's literally just the agent that is allowing you to buy and sell the stocks.
And I'm sorry I started talking about this earlier.
No, it's fine. That's all it is. So when we talk about broker, it's not some person in a back room that we're funneling illicit funds through or anything like that. It ain't a bookie. It's a broker, and that's who that's your Robinhood, that's your Webull, that's your TD Ameritrades, your E-Trade,
Cobra.
Or Cobra. That's just who you're executing the trade to. That's all that is.
They are the middleman.
Yeah, and when we say broker matter, it does. We'll dive into that a little bit more too, but it does matter to a degree. It's not going to make or break you, but if somebody tells you it doesn't matter, I would absolutely disagree with that statement.
It matters a lot.
It does. So last thing, and the reason I put this up here is because I've had people ask me, and you may have too. People have said to me, just flat out said, like, I was looking at opening a broker account, but I'm reading like I can't open an account unless I have at least 25K. So no, that's not the case. But the US, and I think the US only, Canada doesn't have this rule. Basically anywhere outside it's just the US, for better or worse, whatever. It is a US rule that only allows you to take 3-day trades, which remember a day trade is entering and exiting a position within the same day. They only allow you to do that 3 times with a margin account in a 5-day period, unless you have more than 25K in your account.
And that just means I'm sorry. Go ahead.
No, I was just gonna say if you have $24,999, they will only let you execute 3-day trades in a 5-day period, and that does not include weekends and it does not include holidays. It is 5 stock market trading days.
And just for example, on Monday, if you trade Tesla and you buy it one time and sell it, and then you do it again and sell it, you've used 2 of your 3-day trades. And say then on Tuesday you do that again, you buy it and you sell it one time. Well, there's your 3-day trades. You can't trade again until I guess on that next Monday you can make 2, and then by that next Tuesday you can make your 3rd. But it's 5 days in between each one. I mean, you could do them all on one day, or you could spread them out.
It is a massive pain. They say they put it in place to protect us from ourselves, but you know how the government is. We won't go too deep into that.
Yeah, protect us from ourselves.
Yeah, whatever. PDT rule sucks. It is a massive freaking hindrance, in my opinion. But I get it, protecting people from themselves, whatever. But that's what a PDT rule is. There are workarounds, and the reason I put that there is if you have a cash account, you can work around that because a cash account, you can take as many trades as you want. The problem with that is if you have a cash account, it takes typically 3 days. I've heard some take 2, but I think the majority of major brokers are going to take 3 days for that cash to settle on your account.
And you can't short.
Right. So, pros and cons. The other one is the off-sea broker. Again, pros and cons to this. If you have an off-sea broker that is not hindered by the PDT rule, you can buy and sell as much as you want. However, I think you've seen this too. You've been trading long enough. I've seen it a couple times over where there are some off-sea brokers that suddenly just disappear. They're just poof, gone.
Yep. What was it? Sure Trader and I hate to mention names, but
yeah, Sure Trader was one, and I can't remember the other. There was another one that was located in the Bahamas, and I can't remember the name of the broker anymore. But they just disappear overnight.
Trade Zero used to be in the Bahamas.
Yep. And if they disappear overnight, you're not going to lose your. I've never heard of people losing their money, but your money could be tied up for a long period of time until they settle everything, and then you get your money back.
Yeah,
the short of it is. Oh, go ahead.
I was just going to say there is a little bit of a risk because you don't have that FDIC insurance. But me personally, I used one, and I don't want to push any brokers. You can hit me up about this, whatever. But CMEG, you can open an account with them. They're in Trinidad. You can use a very small amount of money, and I mean, you can be like a 16-year-old in a Lambo there. I mean, it's like you can blow an account real quick, but you can also make a lot of money real quick because they have a ton of leverage. You can short hard to borrows, and you can do it with a very small amount of money. So,
and they have no PDT rule.
No PDT rule either.
They're not located in the U.S.
Yeah, that's one of the ways that I grew one of my accounts.
I feel like a lot of people in our space, the small cap short selling space, have used CMEG at one point or another.
The kind of guys that didn't come from just a ton of family money or whatever. Nothing wrong with that if you do. I didn't.
Yeah.
So it's
I mean, sometimes you have no choice. I never opened a CMEG. I did open a Trade Zero account because they're also one of the few brokers that lets you short sell hard to borrows without having 25K in an account. The problem with that is I was restricted to the PD2 rule. Um, so I was able to short the hard to borrows. I was restricted to the PD2 rule. Another workaround of the PDT is, you hold your position overnight, but that can be really tricky if it's going against you. Plus, like we said, pre-market opens up for us at 3 a.m., market time 4 a.m. Waking up at 3 a.m. or 4 a.m. or whatever to see if your position is going against you is no fun. That
yeah, sucks.
sucks. So I don't like to hold overnight unless I'm up nicely on the position. So we use Cobra, and Cobra does require you to have 25K or more to even open an account with them. If you have the ability to do that, they're the best broker, hands down. It's one of those you get what you pay for. But for new traders who are just looking to get their feet wet, looking to open a broker account, to look at charts, to get familiar with some software, I always recommend to people TD Ameritrade because of their Thinkorswim platform. It's free. I still use it. They're amazing. You can't short hard to borrow stocks, but it at least gets you. I mean, it gets your feet wet. And they have a paper trading platform which lets you trade with fake money, fake stocks. For the record, I never recommend that because I think it takes the emotional piece out of it. I'd rather trade with one share of a stock just to do it with real money than paper trade, but that's just me.
That's a good take. And I've done a ton of, like, when I started, I did a ton of paper trading on Webull, and like I've tested strategies with that. They've got a free paper trading strategy that you can get on your phone. I always liked it.
Yeah, and there's nothing, and that's where different strokes for different folks, right? Like some people, paper trading works great, and for me, it wasn't. It didn't give me the I could be trading with $100 million of fake paper money, and I just never got a single emotion out of it.
I didn't get any emotion out of it either. It was a good way to, like, I think the only reason to do any paper trading would be just to literally figure out how to partake.
It's good to learn the software for sure.
Yeah, just to learn how to put an order in.
Yes,
Whatever.
there's definitely pros with that, and that works for some. Like I think part of the reason I didn't do that is I started with like E-Trade. They didn't have paper trading at the time, so I was trading literally a share of stock to get familiar.
I didn't start with paper trading. I just did it kind of along the way. Like I definitely dove right on in when I started, but that's neither here nor there.
Yes. So the last piece we kind of wanted to touch on, and I'm not going to go too deep into this because we could spend an hour or more on this particular screen and little nuance
that it comes on it, man.
Yeah, like level 2 can get very involved, but we just wanted to touch on some very, very basics because we talked about the bid, the ask, the bid-ask spread, executions, and a lot of that lingo that we talked about is on this screen. So just wanted to touch on a few things without getting too deep into it because I don't want to get ahead of ourselves. But when we talk about the bid, when you're trading stock and you can see this level 2, this is literally showing you the auction house in real time. That's what this screen is. That's how you got to think about it. When we talk about the bid, that's the left-hand side. And it usually shows you 3 to 4 or 5 of the best bids of that particular stock, and the same with the ask. It usually shows you the best 3 or 4 as far as the price. So bid side, right? It's got $29.33. Somebody's wanting to buy this particular stock at that price, and they're wanting to buy 600 shares. Then below it, you got a bidder, $29.32, 600 shares. Below that, you got 4 people willing to buy it at this price with this many shares, and then so on and so forth. That's all that is. When we talk about the bid, these are literally showing the buyers that want to buy this stock at the listed price. Adversely, on the ask side, like we talked about, this is the people that want to sell this stock, and they're asking for this price. You got a lot of people that want to sell this stock at $29.36. A lot of people. A lot of shares, 1,900. So you have a lot of people that want to sell this stock at $29.36. So when we talk about the bid and the ask spread, the best bid here, $29.33. The lowest ask here, $29.36. So on this particular stock, there is a 3-cent spread. So when we talk about spread, that's what we're referring to, the difference in the price between the bid and the ask. And with this, the bid is $29.33, the ask is $29.36. If you're wanting to buy this stock, you have plenty of people that are willing to sell it to you at $29.36. So if you put an order in for $29.36, you will get filled. However, if you put an order in for $29.33, you might not. You put in an order for $29.34, you might not. You put in one for $29.35, you still might not. And that's where the problems come in with the spread. Sometimes with the spread, you just won't get executed. And that's just the reality of it. So sometimes if you really want to get into stock, you got to hit the ask, as we call it.
But this market order.
Yeah, or a market order. You hit a market order, they're going to execute you, which in this case is probably going to be $29.36, might be $29.35. But either way, that's
you taking liquidity out of the market.
Yep. And the other piece I want to touch on with level 2 is this far right piece. This literally, it's called the time and sale screen. It's literally showing you this particular stock of orders being bought or sold at whatever price is listed and how many shares of that stock. So level 2 incorporates both. It shows the bid and the ask sides and the time and sales.
Anytime you hear us say tape,
yeah,
that's what we're talking about.
Yes, exactly. If we say, "Oh, we're watching the tape, we're reading the tape, and the tape said this," or whatever. But again, we could go into hours on level 2, but that is just the gist of it. Without going into too much detail, it's just a live feed of the auction house. That's what it is.
I like that analogy.
And some people, and again, this is per trader, some people really depend on level 2 as part of their strategy and their trading. Some people don't even look at it. Switterman on Twitter, the guy is amazing. He doesn't even look at level 2 hardly ever. He literally just looks at the chart. So don't want to overcomplicate it, but that's the basics of level 2. The bid side, the ask side, your buyers, your sellers, and literally a live tape of people buying and selling and how many shares they bought or sold.
I like it. I use it, and I think it's helpful. But some people don't, like you said. And I think there's tons of nuances and things, especially in small caps, which, you know, you're sitting there saying this is how many people want to sell this. But in small caps, they play games with the tape.
It can get
not the tape, but the level 2. They play lots of games with it. They can spoof it in many ways to make you think things that might not be necessarily true. But you know, like I said, we'll have to get into that more later. And I just think that a lot of the terms we use, that we talk about stuff like that a lot. So
we do. And we kind of consider this stock market 101. We plan on doing a stock market 102, and we're debating on doing quote unquote stock market 102 as more of a live format so people can ask questions in the moment as we're talking about bigger, I say bigger, but a little bit more advanced than what we talked about tonight. Or they could ask a live question in stock market 102 about something we talked about today. But we're going to continue this. We're already up on an hour, so we don't want to take up too much more of people's time.
Got it. I get into talking. It's probably
it's a lot, man. It's hard to explain somebody the little nuances, and it can be tough to convey stuff effectively. So hopefully we did that. However, if anybody has questions, leave a comment, hit us up on Twitter, Facebook, whatever. We will answer your questions. We've said this before. We're with New Age Wall Street now. If you're in that room, you join that room. We've said this before. We will do one-on-ones with people for free. If you're in the room, we'll do them for free. We'll do them once a week, whatever. We'll help. But ask questions, leave comments. We'll get back to people. Twitter, Facebook, YouTube, doesn't matter.
Oh yeah,
all the things.
I'll give you my number. You can call me. We can talk about it. Whatever.
I don't know if I'm gonna give you my number. I'm just kidding.
Or I'll give you my Discord number. I might give you my number. I don't even really care.
Yeah, but yeah, man, hit us up, comment, whatever. Hopefully, we help some people. We're gonna continue this. We'll do a 102 version, maybe live, take some live questions, or questions about this one, whatever. But we don't want to like go too far. We're already in an hour. Hopefully, we broke down some basic shit, and we're good, right? Like, we'll continue it though.
That's right.
So
actually, if you want my number, you can just get it from Tatted off Twitter.
I deleted that post.
I'm just kidding, man. I'm just playing.
It's all right. I'll do it again. Don't worry. I'll mess that up real quick.
Do it again.
Oh man, yeah. Okay, so I posted a conversation on Twitter between me and Sellers as a joke. It was funny, but I didn't black out his number. So you got a couple texts that day.
I thought it was hilarious. I loved it, and I still love old Grills. He'll still say stuff to me every now and then. He's a cool guy.
It was funny, but yeah. Hopefully, we helped break down some basics. We'll continue this. If you have comments, let us know. If you have questions, let us know. Whatever. We'll continue this next time. I think we might do it live, but if we do, we'll let y'all know. But yeah, man, this was fun.
Oh yeah.
Class was in session. We'll do it again. Appreciate y'all for watching. Comment, like, subscribe, all that good stuff. If you have questions, hit us up. We're available on all the platforms. You know where to find us. I'll put the Twitter handles in the description just in case. But hit us up. But with that, big dog, I'll hit you up tomorrow morning, same as usual. New Age Wall Street. We'll be in the room. We'll be chatting it up, breaking down trades, game planning, and hopefully starting off Monday with a effing bang.
I hope so.
All right, big dog. Well, with that, peace.
Peace.
I'll holler at y'all later.
See ya.
Back it up.